I'm going to show you in this short video how you can set up your entities in real estate investing for maximum protection, maximum privacy, and minimum taxes. So let's go through the different types of entities that are available to buy, sell, or hold, or rent real estate in, and then we'll put it together, break them down, and then put it back together again so you can see how the big picture works. So here's where we start. There's different types of entities, such as number one, a C corporation, and by default, when you file a corporation, most people file by default, it's a C corporation. Some people will file as an S corporation, which is a specific tax election that a C corp makes to become an S corporation. And then number three, we have an LLC, and as we'll discover, the LLC actually files a multitude of ways, and it's really confusing. And number four, we have a trust. And number five, a limited partnership. Okay, so we'll start with the basic one. A C corporation, which is called an ordinary corporation, is formed by filing with the Secretary of State certain forms and going through some specific procedures, and then it files its own tax return annually. It has owners, we call shareholders. It has officers, president, secretary, treasurer, and so forth. And if used properly, a C corporation can save you a lot of money. If used improperly, there's some negative tax consequences. But either way you do it, whether it's a C corporation or an S corporation, they're both corporations and they both protect the owners, the shareholders, from liability for anything that goes wrong in the company business. So a C corporation has shareholders and it files a tax return. And then an S corporation also files a tax return. But the main difference between a C and an S corporation is, in a C corporation, you can get double taxed, meaning the corporation can pay tax, and then if you take it out as a dividend to the shareholders are then taxed a second time. You may have heard that before, that a C corporation is bad, but if properly used, can save you money. An S corporation, on the other hand, files an informational tax return, a different one than a C corp files. And then all of the income and expenses are passed through to the shareholders as either a profit or a loss, just a net number, profit or loss. So the general rule is here, if you're making more money than you can spend, meaning the corporation, let's say, makes a net profit of 100 and you only need to live on 50, then you're going to go with a C corporation because you can get certain tax benefits that are not available in an S corp. In an S corporation, if you're taking out all of the money that you're spending and you're netting it out to a net zero anyway, then you go with an S corporation. So you probably figured most people start their business as an S corporation, and when they start making some serious change, then they go to a C corporation. So for most of you, you'll probably be starting with an S corporation in the picture of what you're doing. Okay? Now we have an LLC, and now the interesting thing about an LLC is there's 4 different ways that it can be taxed. An LLC files with the state like a corporation. Like a corporation, its owners, which we call members, are protected from liabilities of the company. So C corporation, S corporation, LLC all enjoy the same protection for its owners, limited liability. However, the LLC does not have a tax return. There's no such thing as an LLC tax return. The LLC will choose how it wants to be treated for tax purposes by the IRS. And among the 4 ways, we're not going to talk about all 4, but the most important ones are, it could be a corporation or it could be a partnership. Now, as a corporation, it could be C or S, so it can be a C or S corporation, or it can be a partnership. There's actually a 4th way, but not good for our use here in the discussion, so we'll just ignore that 4th one. So if it elects to be a corporation, it files a corporation return. If it elects to be a partnership, it files a partnership return. Now, what I like to do with most people, especially who are in business and busy and just getting started, is instead of using a C corp or an S corp, and in most cases, again, most of you beginners will be S corps, we use an LLC that is electing to be taxed as an S corp. or taxed as a partnership. And the reason for that is we want to preserve some of the pass-through tax treatment that would be available if you just owned the business in your own name. There are certain tax benefits we'll talk about in just a little bit. So, to sum it all up, now that we've talked about SC corporations and LLCs, what we're going to do is file an LLC, and then one is going to be electing to be treated as a corporation. And then we may have a second entity, which is filing to be treated as a partnership. And we'll see how those work together in the picture when we put it all together after we break it down. Okay, you with me so far? Okay, great. Then we have a trust, and a trust is really not an entity at all. A trust is an agreement. It's a written agreement between two parties, the person who creates the trust and the person who manages the trust. So we have the creator called the grantor, and then we have the trustee who's going to manage it. It's just a written agreement that says trustee is going to manage stuff for the person who created it. Now, people get a little confused with trust. They compare a trust to like a corporation, which has a filing and a tax return. A trust, the type we're going to use, doesn't have any of those things. Doesn't have a tax ID number, doesn't have a bank account, doesn't file tax returns. It's simply an arrangement where one person holds property for another. Now, if you think back to the beginning stages of trusts, back in England, and years and years ago, if you owned property in your own name, you had to go fight in the King's Army. So what someone would do is put the property in a friend or relative's name who's too old and says, look, we'll put it in your name, and so therefore you won't have to fight because you're too old, and I won't have to fight because I don't own the property, but between me and you, I still own it, but we'll put it in your name. And that's basically what a trust is. You're taking title in one person's name for the benefit of someone else. And for tax purposes, the trustee is not the owner. The one who set it up is really the owner. And we'll get back to that in a little bit, and you'll see why that's important and relevant. And lastly, we have what's called a limited partnership, which again is like a partnership here. And sometimes we use what's called a family limited partnership, which is an asset protection device to avoid liability, but also avoid people getting to your stuff if they get a judgment against you. For the most part, a partnership here and a partnership here are 6 of one, half dozen of the other. So what I'm going to do is I'm just going to eliminate this one right here, and there's only going to be 2 entities we're going to use: corporation, LLC, or partnership, LLC, and then a trust. Okay, so now let's review section 1. And by the way, there's going to be 4 sections to this video, and they're all about the same length, so you get an idea of where we're going. In the first section, what we learned was that you can have a C corporation, an S corporation, and you can also have an LLC. The LLC can choose to be treated for tax purposes by the owners as either a C or S corporation or as a partnership. And we're also going to use a trust for certain purposes, as we'll get into later. So if you're just getting started, you're probably going to want to go with an LLC taxed as an S corporation. In addition, if you're going to buy and hold rental properties, as you'll discover, the LLC taxed as a partnership may be the way to go. Let's take a look at it and break it down. Now, let's look at things like income and expenses in real estate, so you have an understanding of why we recommend certain entities for certain types of business in the real estate business. Now, basically, there's 2 types of income that you would earn in real estate. One would be active, and one would be passive. So, if you're earning the income from a passive source, such as rental properties, or you lend money and you could collect interest on a note, that's in the category of passive. So that is treated differently for tax purposes than income which is active, or also known as ordinary, also known as earned. So isn't rental income earned? Not really. It's considered investment income. It's a different nature than income earned over here, which is active, ordinary, or earned. And similar activity that you might be doing now to earn this type of income would be if you have a W-2 from an employer, or you're a 1099 employer, or you're self-employed filing on a Schedule C. That's all in this active, ordinary, earned. And the main difference between the two, the active versus the passive, is what we call Fica tax, which is also known as payroll or self-employment tax, which is a pretty big chunk that comes out of your income in addition to state and federal income taxes. And Obamacare tax, don't forget about that. That applies to everything too if you're making enough. So we want to try to avoid the FICA tax the best we can on our income, because we don't want that nanny system where the government takes money away from you because they think you're too dumb to handle it on your own, and maybe someday you'll get it back. If you're lucky, you'll get all of it. More likely, you're going to get some of it, maybe even none of it. So we're going to try to avoid paying that FICA tax if we don't have to. So if you're doing things like rentals, we want to go over in the passive category. And then over active, we're going to go into a different category, which are things like flips. So if you buy, fix, and flip properties, or you wholesale them, then you're in the active ordinary earned. Now the challenge is here, if the IRS tags you as what they like to call a dealer, a real estate dealer is someone who buys properties with the intention of reselling. And in many of our cases, that's exactly what we do. But if they tag you as that, they're going to want to put all of that income into this category, active, and charge you FICA tax on all of it. And we don't want it on this portion of the income. So what we have to do is segregate the income into two different entities so we don't get that problem coming back to haunt us. Now, in terms of expenses, on the other hand, there are certain expenses you can take against passive income, and there are certain expenses you can take against active or ordinary income. And we want to preserve those the best we can as well, and understand that there are certain types of entities where we can expense things and other types of entities where you cannot. So the long and short of it, if we want to get right down to it, Bill, what is the bottom line here? Okay, let me tell you the bottom line. If you're doing this type of activity, you want to use an LLC as S Corp. And if you're doing rentals and other stuff like that, you want to go with an LLC as a partnership. And that will allow you to get the maximum benefits. Income earned over here in your S corporation, yes, that is active and might be subject to FICA tax, but if you can expense a lot through here and get your net bottom line down to close to zero, then there won't be any tax to pay because there's not much income. But even still, if you have some net income at the bottom that you haven't taken out, then you're probably going to want to go C Corp at some point anyway. But even if you have some income that you've taken out of here and don't want to get taxed FICA tax on, the S corporation allows you to pass it through and eliminate most, not all, but most of the FICA tax. And you're going to get with your tax accountant to further explore that possibility. We don't want to put this activity over here because we're going to lose those expenses and we're going to pay FICA tax. So we keep them separate. Passive, rentals and stuff, and an LLC filing as a partnership. Ordinary, active, earned, flips, wholesales, and an LLC taxed as an S corporation. Okay, we're done with section 1, which was discussing the different types of entities. We're done with section 2, which is talking about different types of income and expenses. Section 3 we're covering now is actually a continuation of section 2, because we didn't talk about one major type of deduction that's available in real estate that you want to preserve, and that is depreciation. Now, when you buy a piece of property that has an improvement, such as a land that has a house or a building on the property, the IRS lets you depreciate the structure. Now, we know that values go up, so it sounds almost counterintuitive, but in theory at least, the structure does devalue, depreciate, wear out. So the IRS gives you a tax deduction against the income from that property or other properties that are in the same class as an offset from the income that you earn. So, for example, you could be earning on a rental property $5,000 or $6,000 a year in positive net income. So rent minus expenses, mortgage, taxes, you can actually have $5,000 to $6,000 net income in your pocket, But once you take the deduction for depreciation against it, which is just a paper loss, it's not a real loss, it will offset or wash it so you pay no tax on that income. And if you can create a loss, which is not that difficult to do, not in reality, we're still making money, but on paper, if we can create a loss, we can take that loss and then use it to wash against other income and reduce our taxes. So let me give you an example. So let's say you have a house over here. That's my house. Okay? And let's say your net income is, like we said, $5,000 per year. Okay? Now, if you can depreciate this, and let's say based on the value of this house, you get a $7,000 per year deduction for depreciation, at least on paper, you lost $2,000. But you didn't really lose $2,000. You actually made $5,000. But on paper, we're telling the IRS, legally, ethically, that we lost $2,000. Now that's great because we didn't have to pay any income tax on the $5,000 in the first place, but now we have this loss. What else can we do with that? So let's say you have another business over here, or you have another job over here, or you have other rentals that are making money over here that are not creating a paper loss. You can take this over here and wash out some of the taxes on some of that income and reduce the overall taxes you pay. Depreciation on rental properties is one of the great gifts that the IRS gives us. And if you're paying too much in taxes now, you just need more deductions. Owning rental real estate is one of the great ways to create the depreciation deduction to offset so that you pay rarely, if any, income tax on your other activities. Okay, so to recap, we've covered the different types of entities, the different liability protections, and the different tax structures. We've talked about income expenses and depreciation and avoiding the Fica tax by being tagged as a dealer and avoiding those consequences. Now we're finally down to it. What you've been waiting for, the piece de resistance, the whole picture, the big picture, the bottom line. All right, get to it, Bill, already. I got it. All right, so let's say you've got a couple of rentals over here. And then you've got some cash assets. And what I mean by cash assets is if you've got stocks, bonds, mutual funds, cash, artwork, jewelry, rare coins, whatever. Those are considered cash assets or cash equivalents, CDs, mutual funds, all of that stuff, because you can pretty quickly turn that stuff into cash. And the most important thing that makes it different than this asset is this asset can cause you liability. This asset can get you sued. This asset will not. Now, you may get sued because you have money, but what I mean is the asset itself doesn't create any liability. So you don't want to put this cash, this low-risk asset, into the high-risk asset category. All right? And let's say you also have some sort of business. And when I say business, I mean anything that is ordinary or active income. So whether you run a storefront, a consulting business, or you do wholesales and flips, whatever it is, all that earned ordinary income is a business. All right? So let's put them all together and see how everything fits. Now, in terms of the real estate, what I like to do is title a property in what we call a land trust. Now, earlier we talked about trusts and how they're just agreements or arrangements between the person who formed the trust and the person who runs the trust, the trustee. Okay? And we said that the real true owner, for all intents and purposes, for tax purposes, for liability, for everything, is really the person who set it up. Okay? So what we're going to do is title each property in a separate land trust. And the beauty of a land trust is this agreement, this land trust agreement, is only known to the trustee and you. There's no public place that you file a trust of this type. So nobody looking on public record can find out who's the true owner, just like the guy trying to get out of fighting for the king's army by putting it in his uncle's name. Similar tactic. what we do is we call the trust something very generic like 223 Oak Street Trust, if it's 223 Oak Street. Okay? The trustee is not going to be you. It's going to be someone who's a friend or relative with a different last name that's not obviously you. Okay? There are types of trusts where people put their name all over it for estate planning. We're not going to use that here. We're going to use this land trust where it's just the trust name and then care of a trustee who's a friend of yours or relative with a different last name at a P.O. box somewhere. Okay? Farther away, the better. Out of state, out of the country, even better. Okay? So people poking around public records, they just see a land trust and there's no physical address or office they can go to. It's just a P.O. box they have to hang out or write a letter to the trustee. And the trustee is going to say, well, the trust agreement between me and the true owner is something I can't reveal according to the trust agreement. So unless they can get that person into court and get a judge to make them, which is very difficult to do, by the way, especially if they're out of state and at a P.O. box, very, very effective barrier to things like lawsuits, tenants, IRS, code enforcement, all these people poking at what you own. The land trust will give you a big layer of anonymity so they don't know who the true owner is of the trust. So each property has a separate land trust, and then the owner of that land trust, of each one, in this case, we're going to dump both of those into an LLC. And this LLC is taxed as a, you guessed it, partnership. Okay? Now, we'll get to who the partners are in a moment. So the land trust title owns the property. The two trusts are set up by and owned by the LLC. Okay? The cash can go right in the LLC, again, because there's no liability of those assets. Those assets don't create lawsuits, so we put it into this master LLC. And then the business, as you probably would have guessed, is going to go into an LLC as an S corporation. That doesn't tie down here. It's a separate entity. And the point here is that stuff that's down in the master LLC is stuff that you want to keep, you want to accumulate, you want to pass on to your family when you die. The business has no value without you. If you died, your flipping business or your wholesaling business has no life. So if this company basically has no accumulated assets, it just earns income, has expenses washed through it, and whatever's left over, you're going to take it out and spend it, then this company, by itself, has no value and you're going to keep it separate. Okay? So your main company that faces the public, the one you do mailers on, the one you have your business card, is going to be this LLC taxed as an S corp. And then your holding company is this LLC, which some people call a family LLC. Sort of like a family limited partnership, but just a different kind of limited partnership called an LLC. And who are the owners of this LLC? Well, typically it's husband and wife. Okay? Now, if you're not married, you can create a partner very easily. So let's say you're just one person. Instead of having wife there, we'll take this LLC and make it your partner. Now there's two owners. Now it files a partnership return. So on the bottom line, where's the money coming from? You're going to take money out of here without most of the Fica tax. You will have to pay income tax on that, though, but you earned it, so there you go. Over here, we have cash assets, maybe earning a return or just holding in here. And then the income and expenses, the net goes into the LLC. And what's nice is everything passes through in terms of the depreciation. So if you have rental property, you depreciate it, everything passes right through to your tax return, so you can use that as an offset against other income from either one property to another or even income from this business. So it'll reduce the taxable income on the stuff you earned over here. And that, my friends, is the whole of it. Thank you very much for watching. If you have any questions, feel free to drop me a line, bill@bronchick.com.